What's up, everybody? It's the Common Sense Investor coming at you with another video. Amy's in my lap. Tonight we're going to talk about the difference between stocks and stock options. When I made that video telling people to comment what they wanted to learn, they told me a lot of people said options, and some people have asked about implied volatility, which is part of options, and amazingly, nobody's asked about the Greeks. But tonight we're going to talk about, I have to start at the basics and talk about what is the stocks and stock options, what's the difference between the two, and how an option would work. So if you don't know what options are exactly, then continue watching the video. And if you're so advanced that you already know the basics of an option, then you don't need this video. I'm just going to be talking about stocks and options and comparing the two. All right. I'm going to be using Apple as an example because I got word last week. That sounds funny. I was watching TV and a news segment come on about Apple. And they were releasing their new iPhone 14. And I thought then, I said, you know what? I might need to take a look at this. And I went over here to my trading view and drew my lines and shit. And I'm looking at the play and I'm thinking, okay, earnings. Earnings right here. It run up for earnings because it's got an earnings coming up right here. So, is the new iPhone 14 going to play into earnings is what I'm looking at. But I'm looking at Apple and I'm seeing where it's at and I'm wondering, should I get into play? But today is Monday. I heard about it last week and I want to get into option, but today is Monday and I don't buy options on Mondays. That's one of my trading rules. And following your trading rules is more important than FOMOing into a play that you think's about to run up. So I missed this run up right here that happened. All right, because even though I was interested in the play, it was Monday and I couldn't get in, and the stock ran up $12. Basically, in the past two days, Friday and today. So I didn't get in. What happened was when I went to Webull and I was looking in my news, doing more investigation, the rise that we had today was due to this article basically that said that they weren't going to raise the prices of iPhone 14s. It's going to stay the same price as the iPhone 13. And people got excited about it and people started buying in. All right. So now let's talk about options and stocks and what I should have done, which I missed this play, but it's no big deal. The stock is trading at 165. All right. It's at 163, but let's just say 165. All right. And in order for me to buy 100 shares of Apple at 165 is going to cost me $16,500. And I'm not willing to bet that just because Apple had some good news here about their iPhones not going up, I'm not willing to wager $16,000 that the stock would go up. So I wanted to take a look at the options. All right, so I went over here to the options and I checked out the 165. All right, now at the time that I was looking at it, it was mere pennies like it is down here because it had that big run up right here. But it's at 410 right now. That means that looking at October, I'm giving the stock a little bit of time for the news to catch up with the stock and push it a little higher. That I believe it's going to go to 165. So I call my broker and I say, look, I want to buy some Apple. He says, sure, how many? I want to buy 100 shares. He said, okay, I want to buy it at 165. And he said, I got you. And you say, hold up. I don't get the money from my lawsuit or whatever until October. So I'll give you the money for the 100 shares in October. So he agrees, okay, you want 100 shares of Apple at 165 in October. And you tell him, yeah. He's going to say, okay, give me $200 premium or down payment on the stock. They say, okay. So you give him $200. Now, October comes, and the stock is Apple is trading at 155, and your broker calls October 7th, said, hey, remember them 100 shares you wanted to buy in October on October 7th at 165? You still want them? You said, fuck no, I don't want them, man. They trading at 155. I'd be taking a $10 loss. I don't want that shit. And he says, okay, no problem, bye. But you lost your $200. You didn't take the trade, but you lost the $200. Okay? But now let's look at it another way. Let's say I called him. Hey, look, I want to buy some Apple, 165. I'm going to pay for it in October. And he says, okay, give me 200. You give him 200. And between now and October, more good news is coming out about Apple. And the stock rises to 175. Now, October 7th, there's a call. Hey, remember you wanted them shares of Apple at 165 for October 7th? You still want them? And you say, fuck yeah, I want them, man. It's trading at 175. Give me my shit. You give him the money, he gives you the shares, you sell them, boom, you got a $10 profit. It's that simple. Problem is figuring out which direction the stock's going to go and which direction your options are going to go. Now, here's what it looks like on a chart, okay? Because I like to look at things written down and I can understand them better. But you call up your broker and you said, I want to buy 100 shares of Apple for $165. You say, I'm going to give you the money for the shares October 7th. And he says, okay, I need 200 down. That's $2 a share for 100 shares that you're putting down as a premium. All right. Now, let's say, for example, on October 7th, you get a call and he says, hey, Apple's up $10. Do you want to exercise those October 7th calls for 165? And you say, hell yeah, give me my shit. Because you're about to pay $165 for a stock that is worth $175. All right? But then what if the market turned on you? What if you were wrong about your Apple stock? And by October 7th, it's not up $10, it's down $10. All right? And your broker calls. And he says, hey, do you remember you wanted to buy 100 shares of Apple at $165? Do you still want them? And you say, man, you can keep that shit. It's trading at 155. Why would I want to pay 165? I don't want them. So you do not exercise your options. And that's about as simple as it can be, people. These are call options I'm referring to. I know they say that the market is not like a casino. If I can buy a call believing the stock will go up, or a put that would believing that the stock would go down, that's like betting red or black on the casino roulette table. So there's a whole lot more. I know there's a whole lot more. You people be commenting, well, you didn't mention this. And I'm like, I commented back to them, it would be a 400-hour long video. So, but that's your basics of options, people. You can say that you want to buy 100 shares of a particular company at a certain date, and you have to put down a down payment. If you're right and the stock goes up and your option goes up with it, you make money. All right. Now, I'm fixing to get into implied volatility. When I tell you how simple implied volatility really is to understand, you're going to be like, damn, that's fucking common sense. I'm also going to be talking about the Greeks. And when you learn about implied volatility, you're going to learn about your first Greek, which is going to be Vega. They go hand in hand, and we're going to talk about that in the upcoming video. Love you. Be blessed. See you there.
Code red, there's been a glitch in the matrix. They out here wildin' and it's too much, I can't take it. Red pill, blue pill, my mind knew they were shaping. Sound the alarm, there's been a glitch.